Hi there, welcome back. Now, on this week's edition of Women's Wednesday, let's take a closer look at the power of financial independence. My colleague Kavita Thapliyal is in conversation with Bharti Sawant, the fund manager equity at Mirae Asset Investment Managers, who shares the to-do list for investment for women. Now, what are some factors that you should keep in mind when it comes to investing? Let's go across and find out.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Hello and welcome to this very special edition of Women's Wednesday. And as always, we are talking about how women can have financial freedom by opting out the right kind of investment strategies, or maybe how can they take the first step towards their investment journey. With me, I have Bharti Sawant from Mirae Asset AMC Equity Fund Manager. Thank you so much for joining us today. And today we'll be focusing on investing in equity via mutual funds, but also understanding the kind of risk reward involved in the process of investment. You know, how important it is for you to understand the risk involved in it. So, you know, as a term, if we see, Bharti, risk reward is something that, you know, all experts like you often come on the channel and just talk about it. But I want you to help our viewers or our women investors who are watching you right now to break it down. Okay, and what do we actually mean by risk reward when it comes to equity investment via mutual funds?
So, first of all, thank you again. Thank you, Kavita, for having me here. Speaking about risk, so there are various types of risk which are involved while we are making investment. The first risk is, as you rightly pointed out, the volatility or the market risk. So, markets are volatile and we generally panic, and generally there is a time that people need money when the markets are down. So, that is the kind of market risk that you carry. The second is portfolio concentration risk. So, if you're if you're overly indexed towards equities or overly indexed towards debt,
like for example, a lot of investors who are just putting their money in small cap and mid cap, you know, last few years we've
so all
seen
eggs in one basket never works.
Exactly, yeah.
So something like that. You should never be overly exposed to any kind of categories.
Sure.
So be it small caps, mid caps, it should be a balanced approach. So concentration risk is very important. Macroeconomic risk. So something like what Trump is what is happening globally in terms of the trade wars, or the actual war which is happening, how that is going to have an impact on the Indian economy, and accordingly what sectors or which themes to play out. So these are the kind of risks. There would be many other risks that one needs to be, but these are the larger risks that one needs to understand before taking an investment call. And that is why we suggest people to opt for equity investments or mutual funds rather, because these guys try and understand all these risks, try to do assessment as to what would be the impact, and then take an informed decision of where to invest.
Sure. Okay. So when I'm talking about risk reward ratio in equity, how would you like to compare it with other asset classes? How would you like to explain it via, you know, comparing it with gold or maybe real estate, debt also maybe?
So one more important risk which I forgot to highlight, which would be helpful in understanding the different asset classes, is the liquidity risk. Sure. That is very important. So something like we consider equities to be highly liquid in nature, but it also carries the market risk, because at what point of time you want to liquidate is important. Like real estate investment. So real estates are highly liquid. It may take maybe years or months for you to liquidate your house. So ideally that should not be considered as an investment. It is more for a personal use, and investment would come only once you've created good enough financial wealth of your own. Because most people, what they do is they invest into real estate by opting for a loan, which in my understanding, I do not consider it to be an investment. Comparing it to, so the returns may be high, but it depends on the period where you have invested, because there has been a prolonged period of say 5-7 years wherein actually the real estate was going through a slowdown, and there was a deflation in certain markets. Then coming to gold. So gold is a safe haven for many. It is obviously because whenever there is a global risk, gold plays out.
It's a hedge against inflation.
It's a hedge against inflation. So people should invest, but then for buying gold also you have gold ETFs. So why invest into physical gold and carry the risk of having a physical gold? Plus the risk, so it is a safer haven, and hence the returns would also be to that extent relatively lower compared to other categories. Debt obviously carries higher relatively low risk, again low returns. So
But
historically,
there is interest rate risk, right, in debt also?
it's a bigger interest rate risk. So if again, like something when the interest rates are going down, so it has an inverse correlation with the interest rates. So each asset class does have some or the other risks. It depends on periods, and hence, as I earlier mentioned, that ideally having the right time horizon is quite important. We can't time the market or any asset class
So
to that.
risk mitigation becomes easier if you have the right kind of time horizon on you.
Plus a balanced approach towards investment.
Exactly. When you talk about balanced approach, I mean, you know, a lot of women investors watch this show, and they are of different age group. They are of different, you know, pay bandwidth also. How can one actually strategize depending on the age group they are in and the amount of money they want to put in? The risk factors you factored in were from the market's point of view and asset class point of view. But from what about your personal risk profile? How do I assess that?
So see, from a personal risk profile, your age and your actual goal matters. Okay. So whether your goal is wealth creation or a particular, say, holiday or a home, something, it depends on that.
So for example,
And where you are in your investment journey.
okay, so at any age one can participate in equity?
They can, but then again, if you're closer to, say, if you're, say, closer to 60, so okay, so at that point of time, equity, the overall exposure to equities should relatively be lower. But if you're starting early, say something like a 20 or 25 or even sub 30, you can be rest assured because you have a lot of time in your hand. And as I earlier also mentioned that typically your time matters. The longer you stay invested, the power of compounding helps. So if you're, say, at the age of 60 and you've just started investing, and if you're investing in equities and suddenly the market crashes, then your entire life savings is at risk. And hence, to have a balanced approach at that age. So maybe once, if you're 60 plus, then it should be more tilted towards debt. But if you're starting early, sub 30s, then it should be more towards
So
equities.
your risk appetite changes as per your age as well, and
Plus
your
when you're-
understanding of asset classes also.
And if you're closer to achieving your goal, then
Yeah.
obviously
then you need a new strategy overall. Then you need to preserve the amount that you've
Exactly.
accumulated.
Exactly.
So it goes more towards the debt. But then thank you so much once again for joining us today for this very interesting conversation. Thank you. That'll be all from my end. Thank you so much for watching.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.